Before we dive in, a quick but very important note. This video is for informational and educational purposes only. I am not a financial advisor, a lender, or a real estate agent. The mortgage landscape is complex and changes constantly. You must consult with a qualified, licensed professional before making any financial decisions, especially one as large as buying a home. This presentation is not financial advice, and your financial situation is unique. Do your own research and speak to an expert. Alright, let's get into it. Picture this. It's 10 o'clock at night. You're scrolling through Zillow again. You know you shouldn't, but you can't help it. You see a house. It's perfect. It's got the big backyard you've always wanted for the dog, the updated kitchen. It's in the right school district. It's the one. Then your eyes drift down to the price tag, $450,000. And your brain, almost against your will, starts doing the math. 20% down. That's $90,000. $90,000 in cash. And just like that, the dream evaporates. Your heart sinks into your stomach, you close the app, and you go to bed feeling like you're stuck renting forever. What if I told you that entire scenario, that gut-wrenching feeling, is based on the biggest myth in American real estate? The myth that you need 20% down to buy a home. And what if I told you the second biggest myth is that you need any money down at all? That's not a trick question. For tens of thousands of Americans every single year, the down payment isn't 10%, it isn't 5%, it isn't even 3%. It's zero. A flat zero. They walk into a home they own with nothing but the cash for closing costs, and sometimes not even that. This isn't some late-night infomercial scam. This isn't a loophole for the ultra-rich. These are legitimate, government-backed, and surprisingly common mortgage programs that most people have simply never heard of, or worse, have been told are impossible. And in this video, I am going to pull back the curtain on every single one of them. We are going to dissect the truth about 0% down mortgages in the United States. I'm not selling you a course. I'm not a lender trying to get your business. I'm just going to give you the unfiltered facts. We'll cover exactly what these programs are, who is eligible for them, the massive pros, and more importantly, the hidden cons and the catches that you absolutely need to know about. My goal is simple. By the end of this, you will know with certainty if one of these programs is the key that can finally unlock the door to your own home. Now, I can hear the skepticism through the screen. You're thinking, zero down? Come on. What's the catch? Is this 2008 all over again? And you are 100% right to be skeptical. That's a smart reaction. The memory of the 2008 financial crisis, fueled by reckless lending, is burned into our collective memory. We all heard the horror stories of ninja loans. No income, no job or assets. People were given mortgages they had no business having, with exploding interest rates, and it led to a global catastrophe. So let me be crystal clear. This is not that. The zero-down loans we're talking about today are a completely different species. The biggest difference? These are overwhelmingly programs created or backed by the United States government. They aren't shady products cooked up in a Wall Street basement. They come with strict, non-negotiable rules. They require full income documentation. You have to prove you can afford the monthly payment. They have credit score requirements. They are designed for stability, not for risky speculation. They are designed to build communities, not to blow them up. Think about the sheer impossibility of that down payment for a moment. The median home price in America is hovering around $400,000. 20% is $80,000. Let's say you're an amazing saver. You manage to put away $1,000 a month. $1,000. That's after rent, car payments, groceries, student loans, and trying to have some semblance of a life. Even at that incredible savings rate, it would take you almost 7 years to save up that 80 grand. And in those 7 years, guess what? That $400,000 house is now a $500,000 house, and your target just moved. Feels like a game you can't win. Even the more common low down payment loans, like an FHA loan at 3.5% down, still require a significant chunk of cash. On that same $400,000 house, 3.5% is $14,000. That is still a massive barrier for millions of hardworking Americans, for nurses, for teachers, for firefighters, for young families just starting out. It's the Great Wall standing between them and the security of owning their own home. It's the difference between building your own wealth and paying your landlord's mortgage. But these zero-down programs, they take that wall and they turn it into a doorway. They completely rewrite the rules of the game. We're talking about two giants in this space, the two most well-known and powerful zero-down options available. the VA loan exclusively for our nation's veterans and service members, and the USDA loan, which is surprisingly not just for farmers, but for huge swaths of suburban and rural America. We're going to go deep on both. For the VA loan, we'll talk about who qualifies. It's a broader group than you might think. We'll discuss the certificate of eligibility, the incredible benefit of having no private mortgage insurance, and the unique funding fee you need to know about. For the USDA loan, we're going to blow up the myth that it's only for buying a farm. I'm going to show you how to check the eligibility map, and you will be shocked to find that towns you might consider suburbs, just outside major metropolitan areas, are often eligible. We'll break down their income limits and why they exist, and the two different types of mortgage insurance that come with it. We'll also touch on other, less common paths to zero down, like grants, down payment assistance programs, and even some special credit union and bank programs that pop up from time to time. This is the complete playbook. The ability to buy a home with no money down sounds like a fantasy. Sounds too good to be true. But for the veteran in Texas, the young couple in a suburb of Raleigh, or the family in rural Pennsylvania, it is a life-changing reality. It is the single most powerful tool for first-time homebuyers in this country, yet it remains shrouded in mystery and misinformation. Today we change that. We're going to arm you with the knowledge that could potentially save you tens of thousands of dollars and years of frustrating, soul-crushing saving. So let's start by demystifying the most powerful home loan in America, a benefit earned through service and sacrifice, the VA loan. For those who have served our country, this isn't just a loan program. It's a thank you. It's a key to a door that, for millions of Americans, seems permanently locked. The VA loan is a zero-down payment mortgage guaranteed by the U.S. Department of Veterans Affairs. Now that word, guaranteed, is the most important word in this entire discussion. Let's break that down. The government isn't actually lending you the money. You're still getting the loan from a private bank, a credit union, or a mortgage lender just like anyone else. But the VA steps in and essentially co-signs for you. They tell the lender, hey, we've got your back. If this service member, for some reason, can't make their payments and the loan goes into foreclosure, we will cover a portion of your losses. This guarantee is everything. It's a shield. It dramatically reduces the risk for the lender. And when a lender's risk goes down, the benefits for the borrower, that's you, go way, way up. This is the fundamental magic behind why the VA loan is so incredibly powerful. It's not a handout. It's a hand up, leveraging the full faith and credit of the United States government to honor a promise made to its service members. Now, right away, I know what some of you are thinking because the myths and misconceptions around this loan are everywhere. The first one is about who can even use it. There's a persistent idea that VA loans are only for combat veterans who just returned from a deployment or for career military retirees. That is absolutely 100% false. The circle of eligibility is much, much wider than most people realize. Of course, it includes veterans who met the minimum service requirements. But it also includes active duty service members. That's right, you can be currently serving right now and use this benefit to buy a home for your family. It includes members of the National Guard and the Reserves, provided they've served for a certain period, typically 6 years. And in a profoundly important act of support, it also extends to certain surviving spouses of service members who died in the line of duty or as a result of a service-related disability. The specific time and service requirements are pretty straightforward. Generally, if you're a veteran, you need to have served 24 continuous months, or at least 90 days of active duty service during wartime. If you were discharged for a service-connected disability, you could be eligible even if you served less time. For Guard and Reserve members, it's typically after 6 years of honorable service. The point is, if you have any connection to the military in your past or your present, you owe it to yourself to check your eligibility. Don't just assume you don't qualify. You get what's called a Certificate of Eligibility, or COE, and it's a simple process to find out for sure. So let's assume you're eligible. You've got your COE in hand. This brings us to the single most life-changing feature of the VA loan, the one that shatters the biggest barrier to homeownership in America, the 0% down payment. Let that sink in. On a $300,000 home, the standard 20% down payment is $60,000. A more lenient FHA loan might require 3.5% down, which is still $10,500. With the VA loan, the required down payment is zero. A flat zero. You can walk into a home with nothing down. This is not a gimmick. It's not a temporary promotional offer. It is the core design of the program. Because the VA is guaranteeing a portion of that loan, the lender doesn't need you to have skin in the game. in the form of a huge cash deposit. The government's promise is your skin in the game. This feature alone catapults our service members ahead by, on average, 7 to 10 years. That's how long it takes the typical American family to save up a significant down payment. With a VA loan, you can bypass that entire agonizing process. But the zero down feature, as incredible as it is only half of the story. There's another, almost equally powerful benefit that saves veterans thousands upon thousands of dollars. It's the complete and total elimination of something called PMI. PMI stands for private mortgage insurance. And if you're getting a conventional loan and you put down less than 20%, you are forced to pay it every single month. PMI is not for you. It doesn't protect you if you lose your job. It doesn't help you in any way. It is an insurance policy that you are forced to buy to protect the lender in case you default. It is, quite frankly, a penalty for not being wealthy enough to have a massive down payment. And it's not cheap. On that same $300,000 loan, PMI could easily cost you between $100 and $200 every single month. Let's be conservative and call it $150 a month. That's $1,800 a year. That's a car payment. That's a family vacation. That's a massive contribution to your retirement account. Over 5 years, that's $9,000. Over 10 years, it's $18,000. Poof, gone. Vanished into the ether. All to pay for an insurance policy that exclusively protects your bank. With a VA loan, PMI does not exist. It is not a thing. There is no monthly mortgage insurance ever. Period. The VA's guarantee replaces the need for PMI. So not only do you get to skip the soul-crushing decade of saving for a down payment, but you also get an immediate built-in discount on your monthly payment for years to come. Your mortgage payment is lower from day one simply because you served. When you combine zero down and no PMI, you start to see the true power we're talking about. It completely rewrites the rules of home buying. Imagine a young Air Force mechanic, just finished her first enlistment. She's in her early 20s, has a steady income from a new civilian job, but her savings account isn't huge. She's been paying exorbitant rent, feeling like homeownership is a distant dream, something for her 30s or 40s. Under the conventional system, she's stuck. $60,000 for a down payment might as well be $60 million. But with her VA loan eligibility, the entire landscape changes. Suddenly, the biggest obstacle in her path is just gone. She can start looking at houses now, not 10 years from now. And when she finds one, her monthly payment will be significantly lower than a civilian counterpart with the exact same credit score and income, because she won't be paying that $150 a month PMI penalty. She is on a fast track to building wealth and stability for her family, years ahead of her peers. This is the promise of the VA loan. It's a tangible financial thank you that translates into real-world advantage. It is, without a doubt, the best mortgage product on the planet for those who can access it. But, and there is always a but, zero down doesn't mean zero cost. It's an incredible deal, but it's not entirely free. While you get to skip PMI, there is a different kind of fee associated with VA loans that every single borrower needs to understand. It's called the VA funding fee. And how much it is, why it exists, and most importantly, how you might be able to get it completely waived, is the critical next piece of this puzzle. Because misunderstanding this one fee can cost you thousands of dollars at the closing table. So let's pull back the curtain on this VA funding fee. What is it, really? Think of it as the VA's insurance policy. The entire reason the VA loan is so powerful, the reason a bank is willing to lend you hundreds of thousands of dollars with zero money down, is because the Department of Veterans Affairs guarantees a portion of that loan. They're co-signing for you in a way. They're telling the bank, hey, if this veteran defaults, we've got your back. We'll cover some of your losses. This guarantee is what removes the risk for the lender. But that guarantee isn't free. The VA needs a pool of money to be able to pay out these guarantees if and when they're needed. The VA loan program is designed to be self-sustaining, not to be a drain on taxpayers. So where does that money come from? It comes from the funding fee, paid by each veteran who uses the benefit. It's a one-time fee that helps keep this incredible program alive for future generations of service members. Now, the first and most important thing to understand is that the VA funding fee is not private mortgage insurance, or PMI. They are completely different animals. PMI is that nasty monthly fee you have to pay on a conventional loan when you put down less than 20%. It can be hundreds of dollars every single month, and it only protects the lender, offering you zero benefit. The VA loan has no monthly mortgage insurance. Ever. The funding fee is a one-time charge, and once it's paid, it's done. So how much is it? This is where the numbers get really important because it's not a single flat rate. It's a percentage of your loan amount, and that percentage changes based on three key factors: your down payment amount, whether it's your first time using the VA loan, and your branch of service, specifically whether you were active duty or in the reserves or National Guard. Let's get into the specifics because this is where you can save or lose thousands. For a first-time homebuyer using the VA loan with 0% down, the funding fee is currently 2.15% of the loan amount. Let's use a real-world example. Say you're buying a $400,000 house. A 2.15% funding fee on that loan is $8,600. Let that sink in. Even with zero down, you could have a fee of almost $9,000. Now, what if you decide to put a little money down? The VA wants to encourage this, so they reward you for it. If you put down at least 5% but less than 10%, that funding fee drops from 2.15% down to 1.5%. On that same $400,000 loan, a 5% down payment is $20,000. Your new lower funding fee is now $6,000. So by putting money down, you just saved yourself $2,600 on the fee. If you can scrape together a 10% down payment, the fee drops even further to 1.25%. But here's a critical detail that trips a lot of people up: subsequent use. If you've used your VA loan benefit before, maybe you bought a house at your last duty station and now you're PCSing and buying another, the fee structure changes dramatically. For a subsequent user with 0% down, the funding fee is not 2.15%. It jumps all the way up to 3.3%. Let's run the numbers on that same $400,000 house. 3.3% of $400,000 is $13,200. $13,000. That is a massive chunk of change. Again, putting money down helps. A 5% down payment for a subsequent user lowers the fee to 1.5%, the same as a first-time user. So that's a huge incentive. For those in the National Guard or reserves, the numbers are slightly different, but the principle is the same. Your first-time use with zero down is a bit higher at 2.4%, and your subsequent use fee is the same 3.3%. So you see these big numbers. $8,600, $13,200, and you're probably wondering, how on earth do I pay that? You have two options. The first is to pay it in cash at closing. You just write a check. But for most people buying a home with zero down, coming up with an extra $9,000 in cash isn't realistic. That's why the vast majority of veterans choose the second option. Roll the funding fee into the loan balance. This is both a blessing and a curse. It's a blessing because it means you don't need that cash at the closing table. You can still buy the house with little to no money out of pocket. But it's a curse because now your loan amount is higher. Instead of borrowing $400,000, you're now borrowing $408,600. And you'll be paying interest on that extra $8,600 for the entire life of the loan, potentially for 30 years. Over 3 decades, the interest you pay on that rolled-in fee can add thousands more to your total cost. This is the hidden cost of the VA loan that catches so many people by surprise. They hear zero down and think it means a free ride. But this funding fee is a very real, very significant expense. But what if I told you there's a way to make that fee, all of it, whether it's $8,600 or $13,200, completely disappear? What if you could get it waived entirely? This is not some loophole or a trick. It's built directly into the program, and it is, without a doubt, the single most valuable financial benefit associated with the VA loan. You are exempt from paying the VA funding fee if you are a veteran receiving VA compensation for a service-connected disability. It's that simple. If you have a disability rating from the VA, and you are receiving monthly payments for it, you do not pay the funding fee. It is completely waived. This also applies to veterans who would be receiving compensation, but are receiving retirement or active duty pay instead. It also applies to surviving spouses of veterans who died in service or from a service-connected disability, and for service members on active duty who have been awarded the Purple Heart. This is a game changer. It takes the one major cost associated with the VA loan and just erases it. It saves you thousands or even tens of thousands of dollars at closing, and it keeps your loan balance lower, saving you thousands more in interest over the life of the loan. But here is the million-dollar tip. This is the piece of inside baseball that your average lender might not tell you, and it can literally be the difference between paying that fee and getting it waived. What happens if you're in the process of closing on your home, but your disability claim with the VA is still pending? You know you have a service-connected injury, you filed the paperwork, but the VA bureaucracy is slow, and you don't have your official rating back yet. In this scenario, you will have to pay the funding fee at closing. You can't get it waived based on a pending claim. So you close on your house, you roll that $8,600 into your loan, and you move on. But let's say 3 months later, you get a letter from the VA. Your claim has been approved. You've been awarded a 30% disability rating. Here's the crucial part. The VA will assign an effective date to your disability rating. If that effective date is before the date you closed on your home, you can apply to the VA for a refund of the funding fee you paid. Let me repeat that. The VA will literally cut you a check for the full amount of the funding fee. They will send you a refund for $8,600. This is life-changing information for thousands of veterans who are in this exact situation. They close on a house while their claim is in limbo and assume they're just out of luck. They're not. You have to be proactive, you have to file the paperwork for the refund, but that money is yours to claim. Make sure you work with a lender who understands this process and can guide you through it. So we've cracked the code on the biggest fee associated with the VA loan. We know what it is, why it exists, and the golden ticket to getting it waived. But many people hear zero down payment and funding fee waived and make a dangerous assumption. They assume they can walk into a home purchase with literally $0 in their bank account. They think it's a no cash to close loan. And that misunderstanding is one of the fastest ways to have your dream of homeownership blow up in your face. Because there are other costs, real out-of-pocket costs you absolutely need to be prepared for. And these are the costs that blindside people at the finish line. Let's start with the first one, the one that proves you're not just a window shopper. It's called earnest money. Think of it as an engagement ring for the house. When you make an offer and the seller accepts it, you're expected to put down a deposit to show you're serious about the purchase. This isn't a fee that disappears. It's your skin in the game. The money is held in a neutral third-party account, called an escrow account, and it's typically applied toward your closing costs or down payment later on. How much are we talking about? It varies by market, but a common amount is 1 to 3% of the home's purchase price. So on a $300,000 home, you need to be ready to write a check for $3,000 to $9,000 right at the beginning of the process. This is cash you need to have liquid and available. Now you might be thinking, wait, what if the deal falls through? Do I lose that money? And the answer is, it depends. Your purchase agreement will have something called contingencies. These are your escape hatches. A common one is the inspection contingency. If the home inspection reveals a cracked foundation or a roof that's about to collapse, you can legally back out and get your earnest money back. Same goes for the financing contingency. If you can't secure the loan you were promised, you can walk away with your deposit. But here's the trap. If you get cold feet for a reason not covered by a contingency, or if you simply miss a deadline outlined in the contract, you can forfeit that entire deposit to the seller. They get to keep your thousands of dollars as compensation for taking their house off the market. So while that zero down loan looks great on paper, you still need a very real, very cash-heavy deposit just to get your foot in the door. Next up, the inspection. This is the single most important $500 you will ever spend in your life. I'm not exaggerating. A home inspection is where you hire a professional to go over the house with a fine-tooth comb. They check the plumbing, the electrical system, the roof, the foundation, the heating and air conditioning, everything. They are your private investigator, looking for the house's dirty secrets. The costs can range from $400 to $800, depending on the size of the home and where you live. This is an out-of-pocket expense you pay directly to the inspector. It is non-negotiable. Let me tell you a quick story. I knew a couple so excited about their first home. They were using a VA loan, so zero down payment. They were trying to save every penny. Their agent recommended an inspection, but they thought, the house looks great, it was built in the 90s, what could possibly be wrong? Let's save the $600. They waived the inspection to make their offer look more attractive to the seller. They closed on the house, moved in, and the first major rainstorm hit. Water started seeping into the basement. Not just a little trickle, a full-on stream. They called a foundation expert who discovered a massive, poorly repaired crack in the foundation hidden behind some drywall the sellers had conveniently put up. The repair cost? $32,000. They tried to save $600 and ended up with a $32,000 nightmare just weeks after moving in. They had no down payment, so they had no equity. They were instantly underwater on their mortgage, all because they skipped the one step designed to protect them. The home inspection is not optional. It's your X-ray of the property, and you have to pay for it in cash before you even know if the deal will go through. Then comes the appraisal. This one often gets confused with the inspection, but it's completely different. The inspection is for you to make sure the house is in good shape. The appraisal is for the lender to make sure the house is actually worth the price you're paying for it. The bank isn't going to lend you $400,000 for a house that's only worth $350,000. They hire a licensed appraiser to come out, measure the property, compare it to similar homes that have recently sold in the area, and give their professional opinion on its value. And guess who pays for this? You do. It's another out-of-pocket expense, usually costing between $500 and $1,000. You pay this fee up front, and it's non-refundable, even if the appraisal comes in low and torpedoes the entire deal. And a low appraisal is a massive problem. Let's say you agree to buy a house for $400,000. The appraiser comes back and says it's only worth $380,000. The bank will now only lend you money based on that lower value. This creates a $20,000 appraisal gap. You now have 4 options and none of them are great. 1. You can try to renegotiate with the seller to lower the price to the appraised value. 2. You can challenge the appraisal, which is a long shot and rarely successful. 3. You can walk away from the deal, losing the money you already spent on the inspection and appraisal. Or 4. You can come up with that $20,000 difference in cash. Cold hard cash. For someone relying on a zero-down loan, coming up with an extra $20,000 out of thin air is usually impossible. So far, just to get through the initial stages, you're on the hook for thousands, potentially tens of thousands of dollars in cash for earnest money, inspections, and appraisals. But we haven't even gotten to the big one, the one that makes people's eyes glaze over. The final mountain you have to climb at the very end of the journey. I'm talking about closing costs. Closing costs are the giant, unavoidable collection of fees required to finalize your mortgage and transfer the property into your name. While you may have a zero-down loan, there is no such thing as a zero-cost closing. This is, without a doubt, the biggest financial hurdle that blindsides first-time homebuyers. So how much are they? As a general rule of thumb, you can expect to pay between 2 and 5% of the total loan amount in closing costs. Let's run the numbers on that same $300,000 house. 2 to 5% means you need to bring an additional $6,000 to $15,000 to the closing table. In cash. In the form of a cashier's check or a wire transfer. This is completely separate from your down payment. So even with a zero-down loan, you could still need to show up with a check for $15,000 just to get the keys. This is where the dream of no money down shatters against the wall of reality. People get their loan approval, they find a house, they pay for the inspection and appraisal, they pack their boxes, and then a week before closing, their lender sends them a document called a closing disclosure. And on the bottom of page 1 is a number under the heading cash to close. And it's not zero. It's a 5-figure number that they simply do not have. So what on earth are you paying for? Why does it cost so much? Closing costs are a bucket of dozens of individual line item fees. They're a confusing mess of lender charges, third-party services, and prepaid expenses. You've got loan origination fees, processing fees, underwriting fees, title insurance, escrow fees, attorney fees, recording fees, property taxes, homeowner's insurance. The list goes on and on. It's death by 1,000 paper cuts. Each fee might only be a few $100s, but when you add them all up, you get this monstrous number that can sink your entire home purchase at the last second. Understanding what these fees are, which ones are legitimate, and most importantly, which ones you might be able to negotiate is crucial. Because hidden inside this laundry list of charges is the difference between a successful closing and a financial disaster. So let's pull back the curtain on this financial maze. Think of closing costs not as one giant bill, but as a series of checkpoints in a high-stakes obstacle course. Each checkpoint demands a toll, and if you don't have the cash ready, you're disqualified from the race just feet from the finish line. We can break this course down into 3 main sections: the fees you pay the lender, the fees you pay third-party experts, and the money you have to prepay for future expenses. Get your head around these 3, and you've basically got the map to the entire course. First, let's talk about the lender fees. These are the charges your bank or mortgage company levies for the service of creating your loan. The headliner here is the origination fee. This is the lender's primary profit center. It covers their administrative costs, the salaries of the loan officers, the underwriters who scrutinize your file, and, of course, their bottom line. It's typically calculated as a percentage of the total loan amount, often around 1%. So, on a $300,000 loan, a 1% origination fee is $3,000, right off the bat. Now, here's the first secret. This fee is often the most negotiable item on the entire list. Lenders are competing for your business, and if you have a strong application, you can sometimes ask them to reduce or even waive this fee. They won't always say yes, but it is one of the few places you have real leverage. Tied closely to this are discount points. This is one of the most misunderstood concepts in mortgages. A point is equal to 1% of the loan amount. Paying for points is essentially prepaying interest. You give the lender a lump sum of cash at closing, and in exchange they give you a slightly lower interest rate for the life of the loan. For a traditional buyer with a hefty down payment, this can be a smart long-term financial move. But for you, the zero-down buyer, it's usually a terrible idea. Your entire strategy is built around minimizing the cash you need at closing. Spending thousands of dollars on points to save maybe $50 or $100 a month completely defeats the purpose. When a lender offers you a lower rate in exchange for points, what you should hear is, "Would you like to pay me thousands of dollars today that you probably don't have?" The answer should almost always be a firm no. In fact, we'll later discuss the opposite concept, called a lender credit, where they actually give you money towards closing costs in exchange for a slightly higher rate. But we're getting ahead of ourselves. Then you have a smattering of other lender fees. The application fee, the processing fee, the underwriting fee. Can feel like they're nickel-and-diming you, and sometimes they are. An underwriting fee covers the cost of the person who does the final, deep dive risk analysis on your file. A processing fee covers the cost of the person who gathers and organizes all your paperwork. Some lenders bundle all of this into their single origination fee, which is cleaner. Others break it out line by line, which can feel overwhelming. The key isn't to get bogged down in the names. The key is to look at the grand total of all lender-related fees and compare that total number from one lender to another. Okay, that's the first section of the obstacle course. Now for the second, the third-party fees. These are charges for services required to get the loan, but they're performed by independent companies, not your lender. Your lender is just passing the bill along to you. The most significant of these is the appraisal fee. The bank is lending you hundreds of thousands of dollars, and they need to be absolutely certain the house is actually worth that much. They hire an independent, licensed appraiser to inspect the property, compare it to recent sales in the neighborhood, and issue a professional opinion of value. This is non-negotiable. You have to pay for it, and it can cost anywhere from $400 to over $1,000 depending on the property's size and location. This is one of the first fees you'll pay out of pocket, often right after your offer is accepted. Next up is title search and title insurance. This is a huge and hugely important category. Before you can own a property, someone has to do a deep dive into its history. They scour public records to make sure the person selling it to you actually has the legal right to do so. They're looking for ghosts in the property's past, unpaid contractor liens, old mortgages that were never properly discharged, boundary disputes with neighbors, or even a surprise heir from a will 50 years ago who technically still has a claim. This investigation is the title search. Once the search is complete, you buy insurance against any mistakes they might have made. This is title insurance. And here's where it gets tricky. There are two kinds. The first is lender's title insurance, which is mandatory. It protects your bank's investment in case a title issue pops up later. The second is owner's title insurance, which protects you and your equity. In many places, this is technically optional, but skipping it is like playing financial Russian roulette. Imagine 5 years after you move in, you get a knock on the door from a construction company saying the previous owner never paid them for the new roof, and they're putting a $20,000 lien on your house. Without owner's title insurance, that problem is now your nightmare. With it, the insurance company handles the legal battle and the cost. Always get owner's title insurance. Then you have the home inspection fee. This is different from the appraisal. The appraiser works for the bank. The inspector works for you. They're not concerned with value. They're concerned with function. Is the furnace on its last legs? Is there a hidden leak in the basement? Is the electrical panel a fire hazard? The lender may not require an inspection, but you should. This is your single best tool for discovering major problems before you're legally bound to the house. Skipping a $500 inspection could cost you $50,000 in repairs down the road. Finally, we have the third section of the course, and it's the one that blindsides most people: prepaids and escrows. These aren't fees for services rendered. This is you putting your own money into a special savings account to cover future bills. It's like buying a car. You don't just pay for the car itself. You have to pay for the first tank of gas and the first year of insurance before you can drive it off the lot. First, there's prepaid interest. Your mortgage payments are typically due on the 1st of the month. But let's say you close on your house on May 15th. Your first official mortgage payment won't be until July 1st. But the bank started charging you interest the second you signed the papers on May 15th. So at closing, you have to prepay the interest for the remainder of the month, from May 15th to May 31st. Here's a pro tip. Scheduling your closing for the last few days of the month drastically reduces this specific cash requirement. Next, homeowners insurance. The lender will require you to pay for your entire first year's insurance premium upfront at closing. They want to know their asset is protected from day one. This can easily be $1,000 or $2,000. And then there are property taxes. Depending on when the previous owner last paid them, you'll have to pay a prorated portion of the city and county taxes at the closing table. All this prepaid money then gets funneled into something called an escrow account. This is a holding account managed by your lender. Every month, a piece of your mortgage payment isn't going towards your loan. It's going into this escrow account. Then, when your property tax bill and homeowner's insurance premium are due each year, the lender pays them for you out of this account. It's a forced savings plan to ensure these critical bills get paid. The catch? At closing, you have to seed this account with a cushion, usually 2 to 3 months worth of future tax and insurance payments. So let's step back and look at the whole picture. You have the origination fee, the appraisal, the title insurance, the first year of homeowner's insurance, several months of property taxes, and a dozen other smaller charges. Even with a zero down payment loan, the closing costs, this gauntlet of fees, prepaids, and escrows, can easily add up to 2, 3, 4, even 5% of the purchase price. On that same $300,000 house, that's anywhere from $6,000 to $15,000 in cold, hard cash you are expected to bring to the closing table. This is the brutal truth of the zero down mortgage. The zero only applies to the down payment. It does not apply to the thousands of dollars in closing costs required to actually get the keys to the house. It feels like a cruel paradox, doesn't it? You've been approved for a massive loan because you don't have a pile of cash for a down payment, only to be stopped at the finish line by a demand for a different pile of cash. It's the final boss battle of the home buying process. But what if there were cheat codes? What if you could get someone else to pay this bill for you? What if the seller or even your own lender could be convinced to cover that entire $15,000 cost, allowing you to walk into your new home with truly, genuinely, close to zero cash out of your pocket? That's not a pipe dream. It's a strategy, and it's exactly what we're breaking down next. The strategy is called a seller concession, or sometimes a seller credit. And on the surface, it sounds completely insane. Why on earth would the person selling their home, the person who wants to make the most money possible, turn around and give you thousands of dollars to help you buy it? It feels like asking the casino to spot you the money for your poker chips. It makes no sense. But it makes perfect sense when you understand the beautiful, elegant math behind the curtain. It's not charity. It's a transaction. And it's one of the most powerful tools a first-time homebuyer has. Here's how it works. You don't just ask the seller for $15,000. Instead, you change the entire structure of your offer. Let's go back to our example. The house is listed for $500,000. Your closing costs are $15,000. You have a zero down loan, but you don't have that extra $15,000 in cash. So you and your real estate agent craft an offer. But you don't offer $500,000. You offer $515,000 for the house. And then in the same offer, you ask for a $15,000 seller concession to be credited back to you at closing to cover your closing costs. Let's pause and look at what just happened. From the seller's perspective, what do they see? They see an offer for $515,000. They also see they have to give $15,000 back. So what's their net profit? 515 minus 15. It's $500,000. They get their full asking price. They are made whole. They are happy. Now look at it from your side. You're now getting a loan for $515,000, not $500,000. But that extra $15,000 isn't going into the seller's pocket. It's being immediately routed by the title company at the closing table to pay for every single one of your closing costs. Your loan origination fees, your title insurance, your appraisal fee, your prepaid property taxes, your homeowner's insurance, all of it. It's paid for. You have effectively rolled your closing costs into your mortgage. The seller gets the money they wanted, and you get into the house without having to write a massive check. This is not a loophole. This is a standard, accepted, and common practice in real estate negotiations across the entire country. You are simply financing your entry fee. And when you combine this strategy with a true zero-down loan like a VA or USDA loan, you achieve the holy grail of home buying. purchasing a home with almost no money out of your own pocket. Now I know what you're thinking. This sounds too good to be true. There has to be a catch. And you are 100% right. There is a catch. And it's a big one. It's the single biggest hurdle that can blow this entire strategy up. And it's a word that strikes fear into the hearts of buyers and sellers everywhere. The appraisal. See, there's a third party in this transaction that we haven't talked about yet. The bank. The lender. The institution that's actually giving you the $515,000. The bank doesn't care what you offered. They don't care what the seller accepted. They have one question and one question only. What is this house actually worth? To get the answer, they hire a neutral third-party licensed appraiser to go out to the property. This appraiser walks through the home, measures the square footage, notes the condition, the upgrades, the location, and then compares it to other, similar homes that have recently sold in the same neighborhood. These are called comparables or comps. Based on this data, they issue a professional opinion of value, an appraisal report. And in our scenario, for this deal to work, that appraisal report has to come back saying the house is worth at least $515,000. If it does, the confetti falls, the deal moves forward, and everyone is happy. The bank is satisfied because their loan is secured by an asset that's worth what you're paying for it. But what if the appraiser's report comes back and says, the house is only worth $500,000? This is called an appraisal gap. And it's a massive problem. The bank will only ever lend you money based on the lower of two numbers, the purchase price or the appraised value. So if the appraisal comes in at $500,000, the bank will not give you a $515,000 loan. They'll only finance the $500,000. That leaves a $15,000 hole. That gap has to be filled in cash by someone. And this is where a dream deal can turn into a nightmare negotiation. You, the buyer, could be on the hook for that $15,000 in cash, which, of course, defeats the entire purpose of the strategy. Or the seller could agree to lower the purchase price to the appraised value of $500,000. But if they do that and still have to give you the $15,000 concession you asked for, their net profit suddenly drops to $485,000. They're not going to be happy about that. The most common outcome is a frantic, last-minute renegotiation where the buyer and seller try to split the difference. Maybe the seller drops the price a bit, and you scrape together some cash to meet in the middle. But in the worst-case scenario, neither side can budge, and the entire deal falls apart over that appraisal gap. You lose the house, and you're out the money you already spent on the inspection and the appraisal itself. So how do you avoid this? How do you use the seller concession strategy without stepping on the appraisal landmine? It all comes down to timing and market intelligence. This strategy is not a universal key that unlocks any door. It works best in specific types of housing markets. Think of it on a spectrum. On one end, you have a red-hot seller's market. Homes are getting 10 offers in a weekend, selling for $50,000 over asking price, with buyers waiving every contingency imaginable. In that market, trying to use a seller concession strategy is like trying to swim up a waterfall. A seller with multiple clean, simple offers is not going to even look at your complicated offer that's contingent on a higher, riskier appraisal. They'll just toss it in the trash. On the complete opposite end, you have a stone-cold buyer's market. The economy is shaky, interest rates are high, and homes are sitting on the market for months. Sellers are desperate. In this market, seller concessions are not just possible. They're common. Sellers expect it. They're often willing to give you a credit for closing costs without you even having to raise the purchase price, just to get the deal done. But most of us live somewhere in the middle, in what we'd call a balanced or normal market. And this is where the art of the deal really comes into play. This is where a good real estate agent earns their commission 10 times over. A savvy agent won't just let you throw this offer out on any random house. They'll do their homework first. They will run their own analysis of the home's value, looking at the same comps an appraiser would look at. They'll be able to tell you, you know what, this house is listed at $500, but it's a bit underpriced. The comps support a value closer to $520. We have room to do this. Or they might say, this one is priced right at the top of the market. The seller is dreaming. If we build a concession in, it will never appraise. We should pass. It's about finding the right property. A house that has some wiggle room in its value. A house that's been on the market for 30 or 45 days, where the seller isn't drowning in offers and might be more flexible. The negotiation isn't just about price. It's about presenting your offer as a solution. Your agent should be explaining to the seller's agent, look, my buyer is fully qualified for this loan. They love the house. The only thing holding them back is the closing costs. By structuring the deal this way, you, the seller, still get your target price, and my highly motivated buyer gets the keys to their new home. It's a win-win for everyone. It's about turning a financial request into a collaborative solution. When you combine a zero-down loan program with a skillfully negotiated seller concession, you have unlocked the core secret to buying a home with minimal cash. You've overcome the two largest financial barriers at once: the down payment and the closing costs. But even after you've cleared those hurdles, there are still other costs. Smaller, sneakier expenses that can pop up and catch you by surprise right before closing, threatening to derail your dream at the last second. These are the costs almost no one talks about, but they are absolutely critical to know. And if you're not prepared for them, even the best laid plans can fall apart. So let's pull back the curtain on these so-called hidden costs, because they're not really hidden. They're just written in a language most of us don't speak: the language of real estate finance. The first and biggest surprise for most people is a giant category of expenses called closing costs. This is the bill you get for the privilege of actually buying the house. It's a collection of fees from everyone who had a hand in making your transaction happen, and it has absolutely nothing to do with your down payment. Even with a zero-down loan, you cannot escape closing costs. Think of it like this: buying a house is a massive, complex legal and financial transaction. You have the lender who's underwriting the loan. You have a title company, making sure the seller actually has the legal right to sell you the property. You have an appraiser, who's making sure the house is worth what you're paying for it. You have government recording offices, who need to officially document that you are the new owner. Every single one of these entities charges a fee for their service. And you, the buyer, are the one who pays the bill. So what are we actually talking about? Let's break it down. Closing costs typically fall into three buckets. First, you have lender fees. This is what you pay your bank or mortgage company for the work of creating your loan. You'll see line items like an origination fee, which is basically a commission for the lender, or an underwriting fee, which pays for the salary of the person who meticulously combed through your financial life to approve you. There might be an application fee, a processing fee, or a credit report fee. It all adds up to the bank getting paid for their work. The second, and usually much larger, bucket is for third-party services. This is where things get really interesting. The biggest one here is often title insurance. This is a non-negotiable, one-time insurance policy that protects you and the lender from any future claims on the property. Imagine years from now, a long-lost heir of the previous owner shows up with a valid will, claiming the house is rightfully theirs. It's a nightmare scenario. Title insurance is what pays for the legal battle to defend your ownership and ensures you don't lose your home over a clerical error from 50 years ago. It's expensive, but it's your shield against financial catastrophe. Then there's the appraisal fee. Before a bank gives you hundreds of thousands of dollars, they want to be absolutely sure the asset they're lending against, the house, is actually worth that much. So they hire an independent appraiser to inspect the property, compare it to similar homes that have recently sold in the area, and give an official valuation. This protects the bank from making a bad investment, but it also protects you from overpaying. You'll also see fees for things like a survey to officially map the property lines, a flood certification to determine if the home is in a flood zone, and various attorney or settlement agent fees for handling the massive amount of paperwork and ensuring the transaction is legally sound. Each of these is a separate service provided by a separate company, and each comes with its own price tag. The third bucket of closing costs is what's known as prepaids, and it's arguably the most confusing. These aren't really fees for services. They are you paying for future expenses up front. The two big ones are property taxes and homeowner's insurance. When you own a home, you'll pay these two things for as long as you live there. To make sure you never miss a payment, most lenders require you to have an escrow account. Here's how it works. Every month, your mortgage payment isn't just principal and interest. A portion of it is also set aside into this special escrow savings account. Then, when your annual property tax bill or your homeowner's insurance premium is due, your lender pays it for you automatically out of that account. It's a safety net. The prepaids at closing are you funding this escrow account for the first time. You might have to prepay a full year's worth of homeowner's insurance and several months' worth of property taxes, just to make sure there's enough cash in the account to get it started. You're also paying interest on your loan for the first month. So, when you add up all these lender fees, third-party fees, and prepaids, what's the damage? The general rule of thumb is that closing costs will be between 2 and 5% of the home's purchase price. Let that sink in. On a $300,000 home, You could be on the hook for anywhere from $6,000 to $15,000. On a $500,000 home, that number could jump to between $10,000 and $25,000 in cash that you need to bring to the closing table, even with your zero down payment loan. This is the number one reason why people who get approved for a zero down loan still fail to buy a house. They celebrate getting the loan, they find the perfect home, and then a week before closing, they get their final closing disclosure and see a bill for $15,000 that they simply do not have. The dream shatters. But wait, it gets worse. Because closing costs are just the first wave of expenses. There's a whole second wave that hits you the moment you get the keys. Let's call them move-in costs. First, there's the literal cost of moving. Whether you hire a professional moving company for thousands of dollars or just rent a U-Haul and bribe your friends with pizza and beer, it costs money. Boxes, packing tape, moving blankets, it all adds up. Then you walk into your new empty house, and you realize it's empty. Maybe the seller left the appliances, maybe they didn't. You might need a new refrigerator, a washer, a dryer. That's thousands of dollars right there. What about furniture? Your old apartment sofa looks tiny in your new living room. You need window coverings. Blinds and curtains for an entire house can cost a fortune. You need a lawnmower, a rake, a snow shovel. All the things you never needed as a renter. And no home is perfect. There are always immediate projects. That bedroom painted a hideous color? You need paint, brushes, and rollers. That leaky faucet in the guest bath? You need a plumber or the tools to fix it yourself. These aren't massive renovations. They're the small, immediate quality of life fixes that turn an empty structure into your actual home. Each one is a small drain on your bank account, and together they can feel like a flood. Finally, there are the utility setup fees. The power company, the water company, the gas company, the internet provider. Many of them charge activation fees or require a security deposit to start a new service, especially if you have a limited credit history. It might only be a few $100s total, but it's another unexpected cash expense you need to cover in your first few days of homeownership. So when you combine that mountain of closing costs with this second wave of move-in costs, the reality of a zero-down mortgage becomes crystal clear. Zero down does not mean zero cash. It just means you've managed to sidestep one specific hurdle. But in its place are a dozen other financial hurdles you now have to clear. Can feel like a bait and switch. You were sold a dream of buying a home with no money, only to be confronted with a demand for $10,000, $15,000, or even $20,000. So is it all a lie? Is the zero-down mortgage just an impossible trap? Not at all. It just means you have to be smarter than the average buyer. You have to know the rules of the game so you can play it to your advantage. Because there are strategies, powerful and completely legal ways, to get almost all of those closing costs paid for by someone else. Let's break down the first and most powerful tool in your arsenal to make this happen. It's called a seller concession, or sometimes seller credit. And understanding this one concept can save you thousands, even tens of thousands of dollars at the closing table. So what is it? In the simplest terms, a seller concession is when you, the buyer, ask the seller to contribute a certain amount of money towards your closing costs. This amount is then built into the final sale price of the home. Now your first reaction might be, wait a minute, why on earth would a seller ever agree to just give me money? And that's the logical question. It feels like you're asking for a handout. But it's not. It's about structuring the deal in a way that works for everyone. It's about understanding the seller's most important number, their net profit. Let me give you a crystal clear example. Let's say there's a house listed for $300,000. You've done your homework, you've talked to your lender, and you know you'll need about $10,000 for closing costs. You have the down payment covered by your zero down loan, but that 10 grand is the roadblock. The average buyer, the uninformed buyer, might offer $290,000 hoping to save money. But you're not the average buyer. You're going to be a smart buyer. Instead of offering less, you offer more. You submit an offer for $310,000, but with one crucial condition. Ask for a $10,000 seller concession to be applied toward your closing costs. Now let's do the math from the seller's perspective. In the first scenario, the average buyer offers $290,000. The seller gets $290,000. Simple. In your scenario, you offer $310,000, but you ask for $10,000 back for your costs. So what does the seller walk away with? $310,000 minus the $10,000 they're giving you at closing, which equals $300,000. Look at those two numbers. An offer for $290,000 or a deal that nets them $300,000. Which one do you think they're going to accept? They're going to take your offer every single time. And why wouldn't they? They're making $10,000 more, and from their perspective it costs them nothing. But for you? This is the entire game. You've just successfully financed your closing costs into the loan. That $10,000 you needed in cash is now spread out over the life of your 30-year mortgage. The impact on your monthly payment is tiny, almost unnoticeable, but the impact on your ability to buy the house is monumental. You've just removed the biggest cash hurdle standing in your way. There is one critical piece to this puzzle, though. The house must appraise for the higher value. In our example, the house listed at $300,000 must be valued by a professional appraiser at $310,000 or more for the bank to approve the loan. This is the bank's way of protecting itself. They won't lend you more money than the house is actually worth. This is why this strategy works best in a stable or appreciating market, and it's why you work with a great real estate agent who can pull comparable sales data and tell you if a higher offer is realistic before you even write it. You don't just guess. You make an educated, strategic move. Now there are rules. The government and the banks put limits on how much you can ask for in seller concessions. They don't want prices to be artificially inflated. And these limits depend on the type of loan you're getting. For a VA loan, the limit is typically 4% of the sale price. So on that $310,000 home, you could ask for up to $12,400. For an FHA loan, the limit is higher at 6%. That's a potential of $18,600 on that same home. More than enough to cover almost any set of closing costs. For a conventional loan, it's a bit more tiered. If you're putting down less than 10%, your limit is 3%. If you're putting down between 10 and 25%, it goes up to 6%. And if you're putting down more than 25%, you can ask for up to 9%. Knowing these numbers is like knowing the cheat codes. When your agent is writing up your offer, you can tell them exactly what your limit is based on your loan type, allowing you to maximize this strategy without breaking any rules. But what if the seller says no? What if you're in a hyper-competitive market with multiple offers, and sellers are refusing to give any concessions at all? Does that mean the dream is over? Absolutely not. This is where you pivot to the second powerful tool. It's called a lender credit. A lender credit is similar to a seller concession, but instead of the seller paying for your closing costs, your mortgage lender does. Again, you might be thinking, why would the lender just give me money? And again, it's not a gift. It's a trade-off. The lender agrees to pay for some or all of your closing costs, and in exchange, you agree to take a slightly higher interest rate on your loan. Think of it like this: the lender can make its profit in two ways: through upfront fees and points, which are part of your closing costs, or through the interest they collect over the life of the loan. With a lender credit, you are essentially telling them, hey, I'm a little short on cash right now. I'd rather you waive these upfront fees, and in return, I'll pay you a little more each month for the next 30 years. Let's say the market interest rate today is 6.5%. Your lender might offer you a deal. They'll give you a $5,000 credit to cover your closing costs if you accept a rate of 6.875%. Is this a good deal? That depends entirely on your personal situation and your timeline. You have to do a quick, break-even analysis. Let's say that slightly higher interest rate increases your monthly mortgage payment by $50, and the lender credit saved you $5,000 in cash up front. You would take that $5,000 you saved and divide it by the $50 monthly increase. The result is 100. That means it will take you 100 months, or just over 8 years, before the extra amount you're paying in interest equals the amount you saved up front. If you plan on living in that house for the next 20 or 30 years, this might not be the best long-term financial move. You'll end up paying more in the long run. But what if you're a young couple buying a starter home, and you think it's pretty likely you'll sell and move to a bigger place in 5 to 7 years? In that case, taking the lender credit is a brilliant strategic move. You'll sell the house long before you ever hit that break-even point. You used the lender's money to get into the house with less cash, and you moved on before you had to pay it all back in the form of higher interest. You get the immediate benefit of keeping your cash, without suffering the long-term consequences. Now, here's where the true masters of the game operate. They don't just use one strategy, they combine them. Let's go back to our $300,000 house with $10,000 in closing costs. You're in a competitive market, so you know asking for the full $10,000 in seller concessions might get your offer rejected. So you make a more competitive offer. You offer $307,000 and ask for a $7,000 seller concession. It's a more attractive offer to the seller, who now nets $300,000 instead of $297,000. They accept. That's amazing. You've just covered $7,000 of your $10,000 closing costs bill, but you still have a $3,000 gap. This is when you call your lender. You say, "My seller is covering $7,000. I still need $3,000. Can you offer me a lender credit to cover the rest?" Your lender runs the numbers. They come back and say, "Absolutely. We can cover that remaining $3,000 if you take a rate that's just 0.1% higher." And just like that, you've done it. You've stacked the strategies. You used a seller concession to cover the bulk of the costs, making your offer attractive. Then you used a small lender credit to close the final gap. The result? You are now getting into a $300,000 home using a zero-down loan, with 100% of your closing costs covered. The total cash you need to bring to the closing table could be as low as a few $100s for the appraisal and inspections. You have cracked the code. This isn't some fantasy. This happens every single day. Buyers who understand how the financial levers work are getting into homes while others are sitting on the sidelines, convinced it's impossible without 20% down. But it requires you to be proactive, to understand the tools, and to communicate clearly with your agent and your lender. But there's still another layer to this. What if you don't want a higher interest rate, and you find a seller who absolutely refuses to negotiate on concessions? What if you need even more help? There are still other pools of money available, funds specifically designed to help you bridge this exact gap. And they don't come from the seller or the lender. They come from a source most people never even think to check. They come from your state, your county, and even your city. We're talking about down payment assistance programs, or DPAs. This is a universe of funding that most first-time homebuyers have no idea even exists. They hear about federal loans like FHA and VA, but they don't realize that their own local government has set aside millions, sometimes hundreds of millions of dollars with one specific goal: to help people exactly like you buy a home right there in your own community. Think of it like this. Your city wants good people to put down roots. They want teachers, firefighters, nurses, and young families to own a piece of the community they serve. When people own homes, they pay property taxes, they shop at local businesses, they maintain their yards, and they contribute to the stability of the neighborhood. It's a massive win for the local economy. So these governments create programs to give you the one thing you're missing: the cash for the down payment and closing costs. But here's where it gets really interesting. This assistance doesn't just come in one flavor. It comes in several different forms, and some of them are frankly mind-blowing. The first, and the absolute holy grail of down payment assistance, is the grant. A grant is exactly what it sounds like: a gift. It's free money that you never have to pay back. It's not a loan. There are no strings attached, other than you have to actually buy a house and live in it. A local housing authority might offer a grant of, say, $10,000 to any qualified first-time homebuyer. You use that money for your down payment and closing costs, and that's it. The money is yours. It's like your city is giving you a scholarship, but for a house. These are the most sought-after programs for obvious reasons, and they can be competitive, but they are 100% real. The second type, which is far more common, is a forgivable loan. And this is where the game truly changes. A forgivable loan is a type of second mortgage. A government agency gives you, let's say, $15,000 for your down payment. This is technically a loan, but it comes with an incredible feature. If you live in the home as your primary residence for a set period of time, let's say 5 years, the loan is completely forgiven. It vanishes into thin air. Let me walk you through how this works. You buy your home using that $15,000 loan. After you live there for 1 full year, the program might forgive 20% of it. So $3,000 just disappears. You now only owe $12,000. After year 2, another $3,000 is forgiven. Now you owe $9,000. This continues every single year until, at the end of year 5, the final $3,000 is forgiven, and the loan is gone forever. You never made a single payment on it. You just had to live in the house. It is the single most powerful wealth-building tool for a first-time homebuyer, because you're essentially being paid to live in your own home. The third type is called a deferred payment loan. This is another kind of second mortgage, but it works a little differently. With a deferred loan, you receive the money for your down payment, and you don't have to make any monthly payments on it. And it usually has a 0% interest rate. The loan just sits there silently in the background. You only have to pay it back when you sell the house, refinance your main mortgage, or pay off your mortgage entirely. Think about the power of that. You get $10,000, $15,000, even $20,000 today. You pay no interest on it for years. You only pay it back in the future, when your home has hopefully appreciated in value and you have built up significant equity. You're essentially using the future profits from your home to pay back the loan that helped you buy it in the first place. It's a brilliant way to bridge the cash gap without adding another monthly payment to your budget. Finally, there are low-interest loans. These are more straightforward. It's a second mortgage for your down payment that you do have to pay back, usually over a period of about 10 years. But the interest rate is typically far below the market rate for your main mortgage. While it's not free money, like a grant or a forgivable loan, it's still an incredibly valuable tool. It's a way to get the cash you need at a much lower cost than, say, a personal loan or a cash advance from a credit card. So, how do you actually find this money? Feels like a hidden treasure, and in a way it is. But there's a map. Your first stop should be the U.S. Department of Housing and Urban Development, or HUD. Their website has a state-by-state list of housing programs. It's a great starting point. But here's the pro tip. You need to think local. Very local. Open up a search engine and type these exact phrases. Your state down payment assistance. Then, your county first-time homebuyer program. And finally, your city housing authority. You will be shocked at what you find. You'll find dedicated websites, PDF applications, and phone numbers for the very people who manage these funds. The other key is to work with a mortgage lender who is an expert in these programs. When you're interviewing lenders, ask them directly, "What down payment assistance programs do you work with in my area?" If they give you a vague answer or don't seem knowledgeable, they are not the right lender for you. The best lenders have relationships with these local agencies and know the ins and outs of every program available. They are your guide on this treasure hunt. Now, before you get too excited, it's crucial to understand that these programs aren't a free-for-all. There are rules. This is the reality check. First, there are almost always income limits. These programs are designed to help low to moderate income households, not high earners. But moderate income can be a lot higher than you think, especially in expensive areas. The income limit for a family in San Francisco is going to be vastly different from a family in rural Ohio. Don't assume you make too much money. Always check the specific limits for your area. Second, there may be purchase price limits. The program might only be applicable for homes under a certain price, ensuring that the funds are used for modest, entry-level housing. Third, you'll likely need to complete a homebuyer education course. Don't roll your eyes at this. This is not a burden, it's a benefit. These courses, which are often online and free, are an incredible crash course in homeownership. They teach you about budgeting, home maintenance, and the mortgage process. They are designed to make you a more successful homeowner, which is a win for everyone. And finally, be prepared for more paperwork and a slightly longer closing process. Because you're coordinating between your lender and a government agency, there are more documents to sign and more approvals to get. This is why it is absolutely critical to work with a lender who has experience with these specific programs. They'll know how to navigate the bureaucracy and keep the process on track. By combining a zero-down loan like a VA or USDA loan with a down payment assistance program to cover closing costs, or by using a DPA grant with a low down payment FHA loan, the dream of buying a home with truly $0 out of your pocket becomes a concrete, achievable reality for millions of Americans. So you've found the program, you've got the lender, and the path to a zero-down mortgage is clear. Feels like you've won the lottery, but this is the exact moment where the biggest mistakes are made. Because getting into a house with no money down comes with a hidden set of risks. Risks that can turn the American dream into a financial nightmare if you aren't prepared. And in the final part, we're going to pull back the curtain on every single one of them. The first and most significant risk is the silent killer of homeownership dreams: negative equity. It's a simple concept with devastating consequences. When you put $0 down, your loan amount is 100% of the home's purchase price. If the housing market takes even a slight dip, 1%, 2%, 5%, your home is suddenly worth less than what you owe the bank. You are officially underwater. Imagine you buy a beautiful home for $400,000. You use a zero-down loan. The ink is barely dry on the paperwork when a local factory closes, or interest rates tick up, and the market in your area softens by just 5%. Your home is now valued at $380,000. But you still owe the bank nearly the full $400,000, plus the interest that's been accruing. Suddenly, you're trapped. If you get a dream job offer in another state, you can't sell. To sell the house for its new market value of $380,000, you'd have to bring $20,000 of your own money, plus realtor commissions, to the closing table just to get out from under the loan. You can't refinance to a lower rate, because no bank will give you a new loan for more than the home is worth. You are chained to that property, praying the market turns around. This isn't a rare, worst-case scenario. It's a mathematical reality for thousands who buy at the peak of a market with no skin in the game. The second risk hits you every single month: a significantly higher mortgage payment. It's basic math. The less you put down, the more you borrow. The more you borrow, the more you pay. Let's stick with that $400,000 house. With zero down, your entire $400,000 is being financed. But if a friend bought an identical house next door and put 20% down, that's $80,000. They only financed $320,000. Even at the exact same interest rate, their monthly principal and interest payment will be hundreds of dollars less than yours. We're talking $300, $400, maybe $500 a month every single month for 30 years. That's an extra $6,000 a year you're paying. Over the life of the loan, that difference could easily be over $100,000. That's money that could have been invested, saved for retirement, or used to pay for your child's college education. Instead, it's going straight to the bank, all because of that tempting zero-down offer at the start. But it gets worse. That higher payment is then inflated by the third risk: private mortgage insurance, or PMI. If you hear nothing else, hear this. PMI is not for you. It does not protect you if you lose your job or can't make a payment. PMI protects the lender. It's an insurance policy you are forced to pay for that only benefits the bank in case you default. Because you put no money down, the lender sees you as a higher risk. So they force you to buy this insurance. It's typically tacked right onto your monthly mortgage payment, and it can be expensive, often an extra $100 to $300 per month, depending on your loan amount and credit score. This is phantom money. Builds you zero equity. It doesn't pay down your principal. It's the financial equivalent of setting a pile of cash on fire in your driveway every month. And with a zero-down loan, you could be stuck paying it for a decade or more, until you finally pay down enough of your mortgage to reach about 20% equity in your home, a milestone that takes much, much longer when you start from zero. The fourth risk is the interest rate itself. Lenders aren't charities. They are in the business of managing risk and making money. A borrower with no down payment is, by every statistical measure, more likely to default than a borrower who has invested their own savings into the property. To compensate for this increased risk, lenders will often charge a higher interest rate on zero-down loans. You might not even notice it. They might offer you 6.5% and you think that's a great deal. But you don't see that the borrower with 10% down was offered 6%. That half a percentage point sounds tiny, insignificant, but it's a financial Goliath. On that $400,000 loan, that extra 0.5% will cost you over $45,000 in additional interest over 30 years. $45,000. For what? For the convenience of not saving up a down payment. You're paying the price of a brand new luxury car for the privilege of walking into a home with empty pockets. And that leads to the final, and perhaps most insidious risk: becoming house poor. This is the great tragic irony of the zero-down dream. You fight so hard to get the house, you sign the papers, you get the keys, and you can't afford to live in it. Your monthly payment, swollen by the large loan amount, the PMI, and the higher interest rate, eats up such a massive portion of your income that you have nothing left. Then the water heater breaks. The air conditioner dies in the middle of July. The roof starts to leak. These aren't possibilities. They are inevitabilities in homeownership. But because you drained your savings or never had any to begin with, every minor repair becomes a 5-alarm financial fire. You can't afford to furnish the house, you can't afford to go on vacation, you can't afford to save for retirement. You own the house, but in reality the house owns you. It becomes a source of stress, not a source of sanctuary. The American dream you were sold becomes a gilded cage. So, after all of this, are these loans a trap that should be avoided by everyone? No. The truth is more nuanced. A zero-down mortgage is a highly specialized financial tool, and for a very specific type of person, it can be the right move. Who is that person? First, it might be a high-income professional who is just starting their career. Think a new surgeon or a software engineer at a top tech firm. They have a very high and reliable income, more than enough to handle the larger monthly payments, but they haven't had the years in the workforce to save up a $100,000 down payment. For them, getting into a home now and starting to build equity in a rapidly appreciating market might be a calculated risk worth taking. The second and most clear-cut case is for our nation's veterans using the VA loan. This is not just a loan program. It is a benefit earned through service. VA loans are one of the best mortgage products on the planet. They typically come with no down payment requirement, no monthly mortgage insurance, and some of the most competitive interest rates available. For a veteran or active duty service member, the VA loan is an incredible and well-deserved advantage that bypasses many of the risks we've discussed. And third, there is the market gambler. This is the person buying in a housing market that is white-hot, with prices escalating by double digits year after year. Their bet is that the home's appreciation will be so rapid that it will create instant equity, quickly erasing the risk of being underwater, and building a wealth cushion that far outweighs the higher monthly costs. But make no mistake, this is a gamble. It works until it doesn't. And if you bet wrong, you're the one left holding the bag when the market corrects. So what is the final truth? The truth about 0% down mortgages is that they are not a shortcut to the American dream. They are a form of extreme leverage. They amplify both gains and losses. They pull the timeline of homeownership forward, but they do so by loading all of the risk onto your shoulders, not the bank's. The most important question you can ask is not, can I get a zero-down loan? The question is, should I? Before you sign a single piece of paper, you must do the hard work. Ask your lender to show you the numbers side by side. What does my monthly payment look like with zero down? Now what does it look like with 3% down? 5%? 10%? Look at the total cost over 30 years. See how much you'll pay in PMI. See how a slightly lower interest rate from a small down payment can save you tens of thousands of dollars. The allure of no money down is powerful. It speaks to our desire for instant gratification. But wealth, true financial security, is almost never built on shortcuts. It's built on discipline, on saving, and on making informed decisions where you understand every single trade-off. The American dream isn't just about owning 4 walls and a roof. It's about building a life of freedom, security, and opportunity within those walls. And the surest path to that dream is never the one you take in the dark. It's the one you walk with your eyes wide open, armed with knowledge, fully aware of the costs, the risks, and the rewards. Now the choice is yours.